Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. Starting with the crude oil prices, which have slightly cooled down. However, reducing gap between the WTI NYMEX and Brent has ensured that the WTI NYMEX hitting November 2014 highs. Now, even though the prices have cooled down, the market remains tight, mainly due to supply disruptions in Canada, Libya and Venezuela. The market is estimating a record demand in the second half of 2018, and the spare capacity has gone down considerably. Moving on to the metal space, we have seen them close the week down in the negative, but the space has stabilized after a sell-off earlier in this week. The base metals have seen multi-month lows this week. Things have been worse for gold though. Gold hit 2018 lows this week and went through its worst monthly decline since November 2016. Indian demand has also gone down by 50% in the last 2 months, while the retail buying is down by nearly 30%. Talking about the currency space, and the rupee hit a record low this week, and a strong dollar, weak yuan, high crude oil prices and the month-end dollar demand will not make life easier going forward as well. Now, to discuss these, we have with us Jonathan Bharat of IRS Alliance and Akhil Mittal of Tata Mutual Fund joining us on the show. Gentlemen, hi, thank you so much for being with us today. Akhil, let me start with you. And it has been a very volatile week, month, quarter, etc. for all asset classes, starting right from equities, commodities, currencies. What, according to you, has been that single thread that has moved it all together?
See, over the last 2-3 months, in fact, there have been lots of fears around global trade wars, how flows are moving towards US dollar, what will be the repercussions of US sanctions against China. So all this combined with the trend of flows out of emerging markets or out of risky assets towards the US dollar led to kind of a sell-off in all the emerging market assets per se. And within the asset classes, equities, fixed income, bonds, we saw sell-off in almost all the asset classes. Coming to countries like India, or coming to countries like which are a net current account deficit country or importer country, the crude prices, the way they remained volatile over the last 3-4 months, that have caused lots of tensions and lots of issues regarding where are we going in terms of the numbers, current account deficits, in terms of impact on inflation, impact on fiscals. So all these worries kept increasing by the day, and the trade wars, the fears of China doing a retaliatory move, all this led to emerging market currencies going where they are. Similarly, trend we saw in India, INR currently trading in 68-69 zone. So things have largely been on account of lots of uncertainty and lots of fear.
Oh, well, absolutely. Those two are the major things that we saw in this week. But Jonathan, while today, of course, has been a day of profit-taking in crude as well, but we have seen very strong gains in this week. There has been a double-digit gain this month as well. Where do you see the crude oil prices headed from here?
Manisha, look, it has been quite a volatile week, there's no doubt about it. I guess I've been focused on the WTI Brent spread. And as you can see, that has come in quite dramatically, which gives me a bit of an edge that I think that a lot of the hype coming out of the States, a lot of bad draws in inventory, 9.9 million barrels, an outage by Syncrude, and a lot of this talk on Iran, Libya, Venezuela, all the geopolitics, all coming together, obviously to make WTI Brent. And in the wake of that, we're seeing WTI go higher, but in the wake of that, it's pulling up Brent.
Jonathan, when you look at both the crude varieties, I mean, last month we saw the gap between the two as high as $11. That seems to have narrowed down to around $5 to $7 this week. How would you read into that? And where do you see the crude prices now moving for the next quarter of rest of 2018?
Well, I think when I look at the spread, as I said, it's a WTI focus at the moment, because you notice that WTI is breaching to new highs, whereas Brent hasn't yet reached that 80 yet. So to me, it is a lot to do with what's happening in the US. and that's sort of pulling up Brent. I get a sense that whilst we get supply issues and more talk, in the Middle East, more draws, less production, I get a sense the market's still thinking there's going to be supply issues. As a result of that, I think for Brent, we can test back through to that US $80 a barrel. When I look at the WTI contract, I can see that moving up into new areas around that US $77. So at the moment, I've got a bid tone on both the commodities, regardless of the amount of production that Saudi Arabia is actually pumping.
Well, okay, so further gains is what we are expecting in case of the crude oil prices. But Jonathan, that really hasn't been the end of it, because we have seen very huge volatility in the metal space also. We've seen multi-month lows for many of them, starting right from zinc to aluminum, etc. The week, of course, is closing on a negative note. What are you looking at in the metal space? What fundamentals would you want to watch from here on? Is it going to be the global trade concerns that would mar the coming month and quarter as well?
Absolutely. I think whilst we still see concerns there, we don't know how that's going to affect economic growth, but the market's speculating that, at the end of the day it will. Now, I actually feel that, with this tension, if I take what Trump's actually on about, he comes out with a lot of bravado, and it's only to get people to the table to discuss what we think is fair. So I think that we're going to get some positive things over the coming weeks out of this tension that we're living with, which has seen base metal markets lower. So as a result of that, I don't think it's as bad as what people feel. And I actually feel that there should be some bargain hunting around this level. If you look at copper, obviously you look at zinc, you look at aluminium, I think that you can comfortably start a buy program in these commodities, given the fact that they're being trashed, obviously, by the trade tensions.
Yeah, another thing really, Jonathan, is that this week it hasn't all been in the negative, because when you look at the ferrous metals, you've seen steel and the iron ore prices actually inch up, and the other metals, of course, have seen their individual fundamentals work for them. So what would you want to pick up on trade, on the long side, on the short side? Which metal would you prefer really for the coming some time?
Look, I sort of think that obviously copper, because that's something that I do like to trade. So I guess from the long side, I like to buy copper. I still feel structurally that that's still a good buy. On the short side, I guess I'm just very disappointed with gold. I'd like to think that we're coming close to a low, but I guess all signals people have just abandoned the metal, and as a result of that, I think it'll continue to be weak. Would I take a short on it? No, but I think it's still got a little bit further to go on the downside.
Oh, well, yes, the gold prices have given a very dismal performance for this quarter. I was about to come to that one. It has seen the worst performing month actually since November 2016 for the month of June. So where do you think gold is headed? Because if you're giving a short call on gold at these current levels, how much further down do you expect it going?
Yeah, look, I think generally, as I said, people are just lost a lot of favour in the metal. And as I said, breaking through that 1250, you can actually get a sense that it's got something like a 1220 on it. It's just people just don't see it, and even with all the tensions we've got, it's not a store of value. So those people that have been holding onto it will capitulate, and I think that'll force it lower. I'd like to see support around that area, around that 20 level. If I get it, then I might have another look at it to buy. I have been long that metal, and I have been wrong. So I'm still a little bit shy to get back into it. So I think it will be a little bit more bearish over the coming couple of trading sessions.
All right, let's get in one more view on that. And Akhil, almost all fund managers have advised adding gold to portfolio in the first quarter itself when the equity markets were looking stretched. But that clearly hasn't worked. But to give the gold prices its due, in the first quarter, we did see the gold prices in positive. But the second quarter not only has erased those gains, but it also has turned the year into negative now.
See, fundamentally, I would say gold would be a hedge against adverse currency movements or adverse inflation. In today's world, though the inflation is inching up slightly, the currency moves are not purely because of central bank's expansionary stance per se, but more because of the US dollar getting into the tightening zone and the Federal Reserve getting into the tightening zone. So as far as that part is concerned, once your central bank starts tightening or once the move starts happening where the currency becomes more precious, that does not really augur well for gold. So though per se if we say equities and fixed income, bond markets, commodity markets are not doing well and things are uncertain, gold should move up. The very fact that currency has been largely, the move has been dominated by the central bank tightening era, that does not augur well for gold. Hence gold is finding it a little bit difficult to find a longer term trajectory, longer term trend. If currency becomes or dollar becomes more expensive, there's really no need to go and buy gold. Gold would be a hedge or a inflation in case of any central bank expansions, in case where inflation is going through the roof. When no such thing is happening, but I guess gold will trade sideways.
All right. So either sideways or a decline in gold is what our experts are telling us. But Jonathan, it's not just gold, because silver prices also have been under pressure, down 2% in this week, 2.5% in this month as well. What's your sense on this one?
I'd like it to stay around there. As we know, silver has that precious feel. It also has an industrial feel. I do feel that there's good support there, but I actually think that it will break, and we will see price a little bit lower for that metal.
All right, so that's the view really coming in for the precious metals and the energy space. But gentlemen, stay on with us. It's a time for a very short break, but we will be back soon to discuss about the dollar rally and, of course, what's happened with our own Indian currency in this week. Welcome back. And it wasn't just the commodity space which was volatile. It was the currency sector as well, which was all over the place. We saw the US dollar index continue to gain up, and the Indian rupee hit an all-time low at 69.09 in an intraday market there. Well, it has been all over the place. But Jonathan, we have seen more than 5% gains on the dollar index in this all quarter. What do you see that performance coming from? What is the impact that it will have on commodities? And for the rest of 2018, are you equally bullish now for the dollar?
Oh, no, I'm not. No, I get a sense that I know that a lot of people are looking at it, but I think concerns that people will be moving away. Remember also, we look at where the Dow is, and the Dow sort of having difficulty break up through that 25,000 level. So I would think the support in the US economy, you'd want to see more of a weaker US dollar to support those exports. I think that the US dollar should be a little bit more under pressure rather than better bid. If not, let's just keep it in a range that everyone's comfortable with. And I think that range, you'd have to be around about that 92 to 97. And to me, if it stays there, then that's going to be positive for economic growth.
Fair point. Akhil, what is your sense? Because the dollar has been on the higher side. Interest rate hike in US is something that has been talked about. The Indian markets, of course, apart from strong dollar, high crude oil prices, it's an election year as well. There's a lot happening, moving around the Indian rupee. We'll come to that a bit later. But are you also looking at, do you agree with Jonathan that the US dollar perhaps will not repeat performance in the second half of 2018?
See, as far as dollar index is concerned, the large part of it is dominated by the dollar-euro pair. Given the recent months, the way euro has behaved, looks like dollar index should strengthen further, especially because dollar is expected to strengthen against euro. But largely moving ahead of DXY index and going per se into larger dollar move across the global economy, I guess, the fiscal expansionary stance by US government and the monetary tightening stance by the Federal Reserve, they both augur well for move of dollar towards the US economy, and hence dollar should strengthen. This combined with the fact that the minting of US dollar is going to reduce going ahead, really leads to a position where the excess dollar liquidity in the world would be going into probably a negative zone. Now, that is the time when you will see lots of rush and demand towards dollar, even gaining more momentum. So, dollar likely to appreciate against most of the currencies, be it a dollar index against euros and JPYs or EM pack as a whole.
All right, clearly both of you don't agree on the fact on where the dollar index can be headed for the rest of 2018. But Akhil, the rupee, 8% of a slide in 2018 till time, 69 taken off. Of course, today has been a day of good recovery before we ended this week. But how are you looking at it now? What is the range you're working with?
See, the volatility has been very sharp. So from a move from 68 to 69 was sharp, and a move back to 68.40 is pretty sharp. I would not want to bet that we have seen lows in the near term. It will largely be dependent upon how the global economy or how the global financial markets behave. Any further depreciation in Chinese yuan is not going to do well for emerging market economies. So India will not be a outlier as far as EM currencies are concerned. If we see a further escalation of trade wars, if we see EM currencies getting hammered further, there is no doubt that even INR will get hammered further. Then comes the second issue that most of the central banks in the EM front, be it Indonesia, be it Malaysia, be it Philippines, Turkey, almost all of them have used interest rate defense for their currencies. As of now, India might not be in a dire need to use that, but as we approach the coming times, if trade wars escalate, if we see a further strengthening of dollar, I don't see that RBI will let rupee appreciate in any sense. They would rather go in for financial stability, thereby increasing their dollar reserves. With my expectations of dollar liquidity being a scarce commodity going ahead, I think forex reserves is a very important asset to hold. So RBI, I don't think is going to do any large move to let the rupee not depreciate. In fact, it is more going to be how the EM pack behaves against the dollar, rather than putting any lid on that we are done for now.
Oh, well, absolutely. And there are a lot of moving pieces of puzzle in the market right now. Having said that, Akhil, what is your sense on where the rupee really could be headed from here? Are we done on the lows? Is 69.8 for the time being? Or do you see a 70 and a level beyond that as well coming in for this year now?
So I guess 66, 72 will be the broader range, more likelihood moving towards 70 rather than towards 66 as of now. If there is any slowdown in terms of talks of trade wars or in terms of comfort coming back to the markets, you could see a move back towards 66. But till such time, domestically, neither the current account deficit numbers nor the trade balances nor the generic rhetoric around the financial markets is going to be very supportive. In fact, to that extent, if FPI flows, financial market flows also start drying up, what we have seen in the last 3-4 months, that's not going to augur well even for balance of payments. So net minus any unexpected positive move, rupee is expected to remain under pressure.
Well, this is about this month and quarter and the week as we are discussing, Akhil. But as we move forward from here, nothing much changes really, because the global trade tensions still continue to prevail. And back home, it's going to be about election year. What are the avenues then to invest? What are the fundamentals and factors that you're looking at? And how would you want to really put in money?
See, it's difficult to put a number. What I can tell you for sure is it's going to be a volatile session ahead. As we approach elections, there will be nerves, especially because the global macros are not supportive. So I don't see anybody having a full-fledged bet on either of the asset classes, be it equity, be it bonds, be it interest rates, or be it commodities. My guess is it's prudent to be cautious. It's prudent to reduce the risk a bit, wait for clarity, especially given the election year and expectations that the government is going to do some sort of relaxations for farmers. Government is in a sense going to be a little bit expansionary. So all those concerns are going to somewhere come into the prices of assets. So as of now, I really can't see any assets giving you out of whack returns. It's a time to be cautious, reduce the risk. At the same time, we have not reached a stage where we have to sell off. It's more of a cautious approach towards asset classes. check your risk parameters wherever you feel it's a safe bet, or that's the amount of volatility you can handle. I think you can go and invest there, but it's not going to be a cakewalk.
All right, point taken. So a word of caution really coming in from our experts. So it really is about more depreciation perhaps in the Indian rupee, more strength in case of the crude oil prices, and the metal prices, of course, within that pack. Copper perhaps will do better is the view from our experts. Thank you, gentlemen, so much for joining us and with your sense on all of that space. But with that, completely out of time on this edition of Commodity Champions. Thank you for watching.